We have the privilege of having Ms. Sherri Bowen from Interlinc Mortgage, and we talk about all the amazing programs that are out there and some of the other programs that aren't so amazing. We also learned this week that Mark wants to fly a plane really bad, and I don't know that I'd land with him because it takes days. So stay tuned and check it out.
Well, today we have Miss Sherri Bowen with Interlinc Mortgage, and we're going to talk about the wonderful hot button of, what is it? What do they call that? I think it's like the distribution of...
Redistribution
of high cost, high risk mortgages onto people with good credit.
Yep.
This is the craziest thing that I've ever heard.
It is nuts.
It is kind of crazy. It's going to be basically if you go up, let's see, you're 740 or higher in the credit score, you're going to see a difference in about a quarter in the rate.
Okay. So I've worked my butt off.
Right.
I've paid all my bills for a really, really long time, and I've just been a really, really good citizen. You know, I've done all the right things, and because of that, I get to pay a 0.25% more.
Thank you, Mark. Thank you. Thank you, because I haven't done that, and now I get and I get the benefit, right?
Yep.
Isn't that how that works?
Yeah.
Oh, congratulations!
Yeah. I mean, I'm just saying, you know, if it works that way, right?
So it's like, if I have, 660, I might be good. I might not have to pay that. But it's not just if you have the higher credit score. It's also if you 20% down. So you're putting a huge down payment, you got good scores, then you're going to see the difference. That's really where it's like
the movie Idiocracy?
No, I have not.
No.
I haven't.
When they started pouring Gatorade on all the farmland because it had electrolytes and then none of the plants grew.
Okay.
I literally feel like we're living in a world of idiocracy.
Well, right.
Days.
It's like a backwards world. Everything is like backwards.
It doesn't make any sense.
Yeah.
And this is forced mediocrity. That's the way that I see it.
Yeah.
It's like, you know what? You don't want to be too good because too good you get penalized.
Yeah, okay,
right?
So let's kind of put not a positive spin, a spin that actually affects our industry, right? Like one thing that, so number one, why are we issuing high-risk loans to begin with? Right? Like, let's talk about that, like, for real. Why would we?
Because we have to keep the economy going. You notice that what has happened is that as the interest rates have pushed up, the credit score requirements have gone down.
Right.
Right? The loan ratio requirements have gone up. Like, they haven't tightened up. They haven't made the ratios worse to where you don't qualify. If anything, they've opened them up. So they've opened up the ability to put people with lower credit into homes that they can't afford.
Right.
Yeah, and they're essentially opening up new programs to try to help with that. So that's another thing. They just came out with that program, that 600 minimum credit score, down payment assistance, so you still owe it back, but it's called like Essex through FHA, and that just came out for that reason.
This is news, right?
Tell
me about it. Tell me about it.
Yep.
Yeah, so the brand new program is, it first came out with the income limit. Now they took that away.
Okay.
So minimum 600 credit score, and basically you're getting almost like a second mortgage, silent second, and so you're covering the 3.5% down payment with that. So that is brand new. You could do two different types of it. One, you can do it either way you owe it back. So let's say you go to sell or whatever it might be.
It's like the old program, remember?
So, it's brand new, and it's just for that reason. It's just to try to...
Is there a cap on the down payment amount?
It's 3.5, right?
Well, it's 3.5. They're literally only doing...
It doesn't matter the loan amount? So you could get 3.5 is it 0%, the silent second?
They're only covering the down payment, so it's FHA 3.5% down. They're only covering the down payment.
But that's what I'm saying. I could do 3.5% down FHA on an $800,000 house.
Well, in Calvert you can.
In Calvert, not in
Calvert. Not in St. Mary's because it's FHA limits.
But I could do 3.5% down on an $800,000 house. Get the 3.5%. Do I pay interest on the 3.5? That silent second?
No.
No payments, no interest.
All right. I'm gonna play devil's advocate for a second. I'm gonna slow us down.
Yeah.
Okay. Because I want to be clear to the people listening what this program does, right? Yeah. So if I'm a first-time home buyer and I qualify for an FHA loan, this program, which FHA is 3.5% down on the loan amount, right? So 3.5% down, you can get a grant to pay that 3.5% down for you.
Yep.
Which would mean
you can 100% finance
100% finance a home. So I want to put that out there because that's
Right.
really big news.
So let's talk about. There's pros and cons here. So we're getting real about this today, right? So we just pivoted from. We've got these high-risk mortgages.
Yeah, we like all over the place.
Right. So we've got these high-risk mortgages.
Yep.
And basically the government is saying, we know that these are probably going to fail.
Right.
But we need them so that we can continue to fuel our economy. So how do we balance out the cost? Well, you, Mr. Good Credit Citizen,
Right.
you're going to have to kick in a little bit extra, and that way that'll help us, cover the cost of this
redistribution
risky,
of wealth.
this risky business that we're doing over here. It's
is.
redistribution of wealth to an extent. It's really redistribution of risk. Right?
Yeah, I love that. By the way, trademark that.
Yeah.
Trademark that.
Yeah,
Redistribution of risk. That's exactly what it is.
And it's basically our government is playing God with our economy.
Well, they
Right?
kind of
always
are, and
they always have.
Right?
They always regulated. But I think it's important for people to recognize what happens. Now, let's bring it full circle. So we're talking about now this 600 credit score program that you can go FHA and you can get down payment assistance. Mm-hmm. That's not a horrible thing. So as we talk about this, we say, hey, this is high risk. Like this, it's not a horrible thing.
I mean, they owe it back, but it's similar to most programs.
It's only a horrible thing if you, Mr. 600 credit score person, doesn't pay your bills.
Pay your mortgage.
Right. The beautiful thing is
and then who benefits? The banks.
Then right.
Right, let's be real.
Then
they get to resell it.
They get to resell it. They've got mortgage
and
insurance. Chris has paid for the mortgage insurance with his higher credit payment, right?
So it's not really.
So listen, I think it's important for people to recognize what's actually happening around you, right? Know that the government is basically saying, we know we're taking this risk over here. And guess what? Risky person. If you're the 600 credit score risky person, you can be the risk, or you can be the person that takes advantage of an opportunity.
Absolutely, you can.
And that's the important thing to recognize and see here. But, let's face it. If you got a 600 credit score, you've proven that you're a risk.
Yeah.
So you need to be cognizant of what you're doing. The other side of this is that it's not just the 600 credit score, right? But the down payment assistance has now made an FHA loan, which, by the way, has some of the more lenient ratio requirements to be 100%. So
there is a cap on that too.
On the ratio?
Yeah, but it's better than our other programs.
Correct.
So,
What's the back?
50.
50. Mm-hmm. So basically, they've basically said, like, hey, you could maybe do a USDA loan, but with USDA loan, maybe only a 400 to 300 house.
And I say 50, but essentially this program, the whole thing about it is it just has to be able to get through the underwriting systems. You might be able to stretch it more, but from what I've found, I haven't been able to do it.
So this is me slowing things down again because I think I listened to it and I understand it because I've been in this. But we end up talking like over a lot of people.
Oh yeah, the debt to income ratio.
Right. So we need like one of the things.
Let's break that down.
Yeah, we need to break that down.
It?
Say what it is. And the other thing is I want to make sure before you leave here we get like what's your thoughts on the market and what's your thoughts on rates and things like that. I want to make sure we get that.
But we almost need 2 episodes with her.
Yeah, I know. Because we could, but I think it's important for us to like break it down really clearly for everybody because it's so we talk in our language.
Yeah. So when we're talking about debt to income ratio, we're talking about what the cap is and all of that. Then that's just
what's debt to income ratio?
Yeah.
I know what it is, but I'm just asking.
Well, how much debt you have versus your basically your income and how much debt you have in your new mortgage.
Gross income.
Yes, gross income.
So prior to taxes being taken out, prior to health insurance being taken out, prior to your 401 being 401k
and we're only talking
out.
about things that are reporting to your credit. So we're not talking about cable bills and cell phone bills and all of that. So when we're talking about
this program allows you to spend 50% of your gross income before taxes are taken out on your mortgage, your car payment.
Well, it's a back ratio, yeah. So basically, any of the debts that you have that are counted against you and your mortgage. So let's say you have a car payment and your new projected mortgage payment, you're going to divide that by your monthly gross income. Right. So that's what the DTI is. That's what we mean.
Basically, by letting someone with a 600 credit score borrow up to 50% of their gross income right? That's a recipe for disaster. Now, I caution saying that because there are times...
I just was going to question you on it, but...
There are a lot of people who can do that.
There are times, but, typically there's contributing factors to that, right?
There are times
when that's okay. So if you're a husband and wife or boyfriend and girlfriend, pretty steady, don't do it if you just met her last week or him last week, right? But same scenario. You got a 600 credit score, you qualify, you can go to 50%. Well, you could stretch it to 50% because we're not counting the income of the other person that's pitching in. Let's say that you're a single individual and you are the person that's going to take advantage of the opportunity that this program provides. Well, if you're smart, you could have roommates. If you're a first-time home buyer, you bring in 2 roommates, you rent out 2 rooms, you could pay for the whole mortgage. So it depends on how you look at it, and you got to have a plan around it. But if your plan is, I have a 600 credit score, I'm going to go to 50% of my gross income, I have no additional income, I have nobody else living with me contributing, that is a recipe for disaster.
Well, you have to, number one, be prepared to make the payment no matter what, right? Like you have to be equipped to make that payment.
And now let's also talk about the other hand of it. You think that they're just giving it to you for a great rate? No, the interest rate on it is higher.
Oh, it is.
Okay. That's just the way that it works, But I will say they have 2 different options. So one is that, you can actually pay the loan back over time. So your second mortgage, you're actually paying on it, and there's actually interest on it.
So it's no longer really a grant. It's more like
Well, it's not a grant.
Either way, it's a grant, not a grant, because they always owe it back.
Yeah.
But the 10-year, basically over 10 years, they're going to pay the second mortgage back. Now, that rate does tend to be a little bit better because... In reality,
we didn't even talk about the rates on this program.
That's what we just said.
So what are the rates on this program?
It's not like a set rate like some programs. Like you're still pricing on the general market with an investor, so it's still changing and fluctuating. But I priced one the other day, and it was 7.25%.
7.25%.
So it's about.
That sounds ugly.
It sounds ugly.
It's not terrible because
horrible.
MMP has been 3%. MMP has been about
MMP is Maryland Mortgage Program.
Has been about 6.375, 6.5. So yes, it's higher, but you have to understand is Maryland Mortgage Program. You're doing the same thing, but you need a 640. So this is how we're getting those people into the program.
So low credit scores, you pay for it with your low credit score. Chris pays for it for his high credit score.
It always sounds, excuse my, it's like ass backwards, right? Like think about it for real. Let's, we're going to charge the person who can't afford it more.
Yeah.
So that right? Like it just makes no sense.
And you guys do know that like when we price a loan and you're putting 20% down, it's about an 1/8 difference in the rate already, no matter what. Yeah. So you're actually getting an 1/8 more against you, just because of
So what?
That makes no sense.
Because you're putting more down, so you're depleting mortgage insurance, so they get you.
They're tacking it on.
Right.
Yeah. What's going on in mortgage rates?
Where do I see the rates going? Well, there's supposed to be an increase in rates this week, so I keep thinking that they're coming down, and I know it's coming. Like we're not going to sustain where we're at right now, but it's also that fact of how hot is the summer market going to be? How crazy are the sales prices going to get? Are they going to be forced to, keep the rates where they're at because the sales prices start to go up because we have multiple offers again? That's the question. We can't really tell what's going to happen over the next few months. But do I believe that the rates will drop in the next 6 to 22 months? Yes, but that's only because history doesn't lie. Like if you look back and look at what we're in right now, it's always happened in history, every single time. Yeah. So
we've experienced it. Usually, you go through these cycles, but we've just gone through a longer blip of these low rates, and like the standard of the industry standard was in the 2s and 3s for so long, right? That they became a standard perception that that's what they were all going to be.
Which, by the way, that's what caused this, right?
Right, exactly. It's unheard of to keep those rates for so long,
right?
And the banks can't sustain it for that long of a period, obviously. And now they have to recover. And by the way, a 6% interest rate is not bad. Let me put that out there, right?
That's another thing.
Not a bad rate.
I think another thing to just take note on is that what people don't recognize is the rates would be being pushed higher right now if 3 banks didn't fail.
Well, that's another thing.
Right.
That's a whole nother.
That's a whole nother story.
And more banks are still going to fail.
Right. It's probably way above everybody's
But that's
head,
also the other good thing, right? So
Yeah.
it's a good thing that banks are failing. People think they're failing because they're failing because people are pulling their money out of them.
Right.
So if that keeps happening, that keeps rates down, and that's a really good thing. So
it's a good thing for the rate market.
It is a good thing for the rate market, yes. Yeah. But that's the thing. We need stuff to counteract what's happening so they don't keep going up.
Yeah.
This is such a big...
But it's good and bad, though, because it's going to basically string out inflation.
Yeah.
Because now they're kind of like sweeping inflation under the rug, and they're like, we're not even going to talk about inflation anymore, but we just need to settle down on these rates so we don't break any more banks.
I think it's important also because I think the average person doesn't realize when they hear on the news that, like, the feds are going to raise rates, they immediately think mortgage rates, right? Like the average consumer thinks it's mortgage rates, and it's not, right? And the mechanism, it's a mechanism for the government to play God, right? Let's be real, right? And to say, oh, the economy's out of control, we're going to raise rates so we don't spend as much. You Americans, we're not going to, we're not going to let you spend as much money. But I often thought, this is a whole nother sidebar, but it actually is important. I often thought, like, okay, so you're going to the feds are going to raise the rate, which actually increases the costs of goods, particularly foreign goods, by the way. Let's talk about that, like import, exports, which increases tariffs, right? Because you're going to have to be paying more on the tariff, right? So doesn't it really just generate more money for the federal government in their coffers when the Fed raises the rate? It's just a whole nother sidebar. Like, it's conspiracy theory, right?
Yeah.
I mean...
Well, and governments are really... They should be trusted with money. Sure.
Right. I trust them.
They're going to do a great job with it.
They do a great job with it, for sure.
Historically.
For sure. Right. And they don't want to take much from us.
Yeah.
But was that sarcasm?
Yeah. I think the most important thing to land the plane with here, and this is kind of a self-promoting on behalf of me and Chris, it's so important that you work with someone who knows what they're doing, who's truly going to advise you, because guess what? If I'm a part-time real estate agent and I'm just trying to make an extra check, and this doesn't go for everybody. I
totally get what you're saying here.
This doesn't go for everybody because I'm probably going to offend some agents out there.
No.
But at the end of the day, if you're in the real estate business just to make extra money, okay, you're not going to be advising the 600 credit score person who stretches himself to a 50% back ratio and really can't afford that payment.
Mark, how many times have you said to someone, and I know you have because I've done it too.
Yeah.
Are you sure this is what you want to do?
Yeah.
Are you sure this is where you want to be? Because we know
a countless number of times.
Right? And a lot of people don't take that because we take our clients seriously. We want to make sure they're not getting themselves in a bad position or doing something that's going to hurt them later.
Now,
unfortunately,
now on the other side, I also have clients that are super conservative, but then they want what they want, and we have tough conversations today. That's like, look, you're either going to spend $500 more a month than what you want.
Right.
Or you're not going to get the house that you want.
Right.
You get to make the choice. And these aren't situations where they're stretched to a 50 back ratio. Maybe they're at a 35 or 40, which means that they can truly afford it. They just don't want to spend the money. And it's like, look, it's up to you. And I will say there is some honesty in, if you take on something, especially if you're a conservative individual like that, and you take on something that's a little bit outside of your comfort zone, it actually ends up propelling you in most cases to save more money, to hunker down on your budget, and to ask for a raise, look for ways to make more money, right?
Yep.
But the key is
debt-driven.
It all debt motivation,
debt motivation.
Which isn't always the greatest, but it all comes back around to you need someone who's able to see that picture for you and say, look, this is what's best for you. Not this is what's best for my
and it's
wallet.
our job to know it and be knowledgeable enough.
And I do it all the time too. I tell them all the time, I'm like, look, this is where you're at. This is what I think. And then I tell them, and then I go over the whole budget thing with them. And I break it down, and I'm like, I can either help you through the budget, or you guys can sit down yourselves, but these are the things. You need to list out everything that you have. And usually they'll come back and say, it happened to one of our clients last week. I said, did you guys go over the budget? He said, yes. We feel as if we have room for this payment. We've already broken it all down, what they're going to have over, leftover extra money, and they feel comfortable. I feel good about doing that once I do that, because then I feel like they're comfortable. But it's also...
Is that the ones that we wrote on?
Yeah, last week, yep.
Gotcha.
So, at the end of the day, it's also like, if I don't do the loan, or I say, or I have a lot of pushback, then it's also like, well, they'll find someone else who will just pick it up and do it. 'Cause there's a lot of lenders who just...
And again, by knowing the ratios, having a conversation, I knew that. So I was able to say, hey, you can afford this. It's up to you whether or not you choose to.
Yeah.
That's exactly
right.
right.
Yeah.
And you, if you want this house, you want a house like this is what you got to do.
Right.
But again, it all just boils down to working with somebody that you can trust that's going to help you make those decisions.
Well, we've talked from over there to over there about
Yeah.
mortgages. It's like kind of like
We bounced all over the
We
place.
did.
Yeah, well, it's hard. There's so much to mortgages. I mean, there's programs, there's rates, there's the market. There's so much. Like people, I don't know. That people
So
don't realize how
listen,
much
I
there
think
is.
where we land the plane. What, you were going to say something?
no. I just want to make sure we give Sherri her opportunity. Like she's,
Yeah.
people. How do they reach you? Like, I mean, obviously you know what you're talking
Mm-hmm.
about. We want to make sure that people have the opportunity to reach out.
Yeah, I mean, you can find me online, Sherri Bowen, pretty much anywhere. I work for Interlinc Mortgage, so you can find me just by searching that. And then also, yeah, my cell phone number is on there, and
Awesome.
super
What are
super
your-
easy to contact.
Why would somebody work with you versus any other lender out there?
So I think there's a couple aspects that are super important. Number one is I'm going to pick up the phone throughout the entire process. You know, I'm there on the evenings to help you write an offer if you need to. I'm there on the weekends to help you write an offer if you need to. So I think that's super important. And then just like being truthful and being, you know, like I'm local. I'm in the area. You can see me. You can meet me in person, live and local, right? Like that's the whole
Right.
point. And so I just think, you know, I'm going to take care of them the best. It's not just, they're not just a client to me. Like they become family and all that stuff. If you're working with, I won't say, but like big banks and stuff like that, they're not, this is just
You're a number.
transactional.
Yeah, no,
it's
and
all
there's total
transactional.
truth. I always
Yeah.
say, you know what I always tell my clients is if you're going to use a lender, I'd rather be able to go knock on Sherri's door and say, what the heck is going on with this loan
Right.
today, right? What
Versus
is going on?
The big boys,
Instead of,
Yeah.
you'll spend 30
please
days
press
trying
one.
to figure out what's going
right,
on. Yeah.
Right,
Yeah.
please press one.
Press 1, press 4, like
Right.
4 hours later you have
And
no
I'd
answer.
Yeah,
rather
you
be
never
able to
know.
go after and talk to you and find out what the real story is. So I definitely appreciate that from my side. So
Awesome. Yeah.
Anything else before I land the plane?
you've been landing the plane for an
You've
hour,
been
right?
landing
You've been
the
landing
plane.
it like you're halfway across the Atlantic trying to fly in.
So look,
Yeah.
I just wanted to say I think that from where we've gone through this whole conversation, right? So we talked about a trusted advisor is incredibly important. But more important than that is that you see if you've got a 600 credit score, you know, between 6 and 640, you need to see the opportunity that's in front of you
Yeah.
and take advantage of the opportunity. Don't overextend yourself,
Right.
but you have an opportunity to get yourself into a home right now versus waiting, right?
And
Yeah.
also
And-
remember, you can fix that too. Let's
And
put
yeah,
that,
you
know, I
can
mean,
work
that's
on
like-
your
that
credit.
was
we
a
can
whole
talk
nother
about that
thing.
too, right?
Yeah, I mean, when he kept bringing that up, that's another thing. Like, do I keep everyone at the 600? No. Most of the time, I'm trying to push them over the 640 so they can use other programs.
Right.
USDA being one of them. So I just, you know, I don't think you're set in that. And another lender's not going to do that for you, by the way. They're not going to sit there and work on your credit, but I will. So
And I
that's
can't
also
tell you how
another
many
thing.
times that we've had a conversation with somebody. Look, we could put you in this FHA program today,
Yep.
or we could do this, this, and this, and in 3 weeks we can get you into this
the
other
other
Yeah,
program. Yeah, that
another
happens a lot,
program,
right?
and
Yeah.
then you might not need a down payment, which is a huge difference for you. So
Yeah.
there's all these things that we can do, and it might be as simple as opening a credit card or paying one down, you know. So I just think it's super important that you work with somebody who's going to get you the best thing. So
No, I mean, what you said makes a lot of sense. I've had people, you know, where we can use you've saved this much money, we can use it to pay off this debt
Yep.
instead of using it towards your down payment or whatever, in addition to, and save you, tens of dollars or
yeah,
whatever
in the
on your
future,
monthly
it's a
payment,
lot of
you know.
money if we're
Yeah.
talking payment and
Right.
you know it's a cheaper payment or
Pretty
something
cool.
like that. So yeah.
All right. With that, Sherri, thank you for coming in here.
Thanks so much.
This has been like
Thank
a
you.
whirlwind of information today, and
Yeah.
we've been landing a plane for half an hour.
Yeah.
With that, thank you guys. We'll see you next week.
Yes.
See ya.